Hello, everyone, and welcome to this Angeles Investors webinar. Today, I have great company. I'm with Lister Delgado, and we will be discussing about how to evaluate a startup's founder market fit. And Lister's got a lot of experience in this topic. Our guest, he's a managing partner in Idea Fund Partners. He's got over 2 decades in investing at seed and investing in this low level. And he's got a lot of experience as well as in deep B2B marketing and data focus. So, Lister, welcome to this session and let's have a great conversation.
Thank you, Joshua. Thank you for inviting me to speak to Angeles.
Yeah, it's a pleasure. And Lister, let's start by giving us a little bit more about your background before we get into details.
Sure. Yeah. Let's see. I don't want to bore the conversation too much to give you too much background, but I have to say I was born in Peru. I'm Peruvian, although my mother is Cuban, so one half Cuban, half Peruvian. I came to the U.S. when I was 17, and I was an engineer, electrical engineer. Worked as an engineer for a while, and and after some time in the professional work, I jumped into the investing world, and I've been making investments, as you said, for now 25 years. So hopefully, I learned a couple of things along the way, but I will tell you, mostly it was by making a lot of mistakes, which is how you learn the best.
Yeah, and over 20 years in experience, that give you some credibility in terms of are those 20 years all angel investing that you've done
No, no,
or you
no.
started with different assets?
Yeah, I have more experience as a venture capital manager. And I think that is an important differentiation. An angel investor invests their own money. But what I've been doing, of course, I have to invest my money too, but it was part of a pool of money. So there's a different level of perspective uh, because I have to be very careful with somebody else's money, maybe more so than my
Of
own.
course.
So I've been running a venture fund for 25 years. And the one luxury that being a professional investor gives you is you have more time to do due diligence. And an angel investor sometimes doesn't have the luxury of all the time. So, but it's always been in the seed and early stage, ideas that are just being born, new companies, pre-revenue companies, many times, or early revenue companies.
Good. And it's interesting because as we discuss more into venture, it is high risk, high rewards. You can say when you manage private equity, it's big companies that they have already a bunch of data that you can have access to and make your decision, right? But when we talk about the startups, and that's why the due diligence is so important, is it's basically your job before, putting someone else money in it, right? So that's why this topic, how to evaluate a startup founder market fit, is so important. But before we dive into this topic, let's ground the conversation in the single biggest failure mode we see across early stage startups, which is building something that the market doesn't urgently want. So sometimes we see that the postmortems consistently show that there's no real market need at the top of the list. Sometimes the founders just create their startup, their company, and they have improved it, they have improved the market. So my question is, when you test a founder market fit in the first meeting, what evidence convinced you that the founder has validated a real urgent need rather than a nice to have or it's
Hmm.
something good to have, right?
Well, I guess convince is too strong of a word, really. I don't think you're going to be convinced by anything that you hear in one meeting. And I think that's number one. I think it's important to, however, for the entrepreneur to make sure that they establish credibility. And, uh, and, and I think the other piece that is important is that, to me, what makes it worth having another conversation to continue to dig in and learn more is that the magnitude of the solution, first of all, that the problem is real, And that is usually not so hard to assess. You have to give the entrepreneur the benefit of the doubt initially. But then what's important also is that the magnitude of the solution is significant. You can't just have a nice to have. You have to have a solution that is fixing a problem in a significant order of magnitude, 10 times better than the existing solution. Because otherwise, it's very difficult for a small company, for a startup that is just getting started, to either disrupt an existing market or create a new market. So it's important that there's a significant distance between the solutions that are there and the new solution that the startup proposes.
Mm. For example, when you are asking and you're meeting the founder for the first time, what are those two or three questions that you ask immediately so that you measure and have an idea if they've already tested the market and it is not just a nice to have? Can you give us an example of two or three questions you make them?
Um, uh, well, I don't know that there's a perfect question, but what I like to start with, to me, the first question, probably the most important question that tells me a lot about the founder and the team is, tell me why you started this company, the why, the origin story of the founder. Usually, when you ask why you're doing this, how did you get started, you start to get into the motivations of the company, the founder, for creating this company. And along the way, inevitably, what needs to come out is the the thing that created the light bulb moment. So usually along the way, if the founder doesn't provide an explanation that tells you, yeah, that story makes complete sense. I saw it this way, and I saw the problem being significant. I lived it, or I studied it, or I experienced it, or somebody told me, or I felt that it was important to investigate. So origin story questions are great, uh, and usually I don't think you need to dig in too much with specifics. If the founder doesn't have a story to tell, you don't need to chase it. So I usually that is my go-to question, and usually that single question, why you're doing this, how you get started, those kinds of questions, tell me most of what I need to know.
Perfect. Thank you, Lister. And and I believe that's interesting, but let's separate signals from noise because founder traits are measurably is where they measurably impact outcomes, right? And the data study shows it clearly. Founder level factors predict success beyond company variables. So the question isn't just is the product good or it's the founder truly aligned with the market. And in here I want to ask you which founder traits most reliably indicate fit with their market, and how do you elicit those traits in diligence and without overweighting charisma? Because sometimes
Yeah,
these founders are all over charisma and
that's true.
they can
That's true.
trick you, right?
Yeah, no, you're completely right. I think it's very difficult to avoid being biased by charisma. I don't think there's nothing wrong with that because charisma is what that founder is going to need to get other investors, is what they're going to need to get uh, customers, is what they're going to need to hire people. So I think how the entrepreneur provides and shows charisma when they pitch into you, that's not a bad thing. However, you're right. I think you can overweight the importance of that charisma and you can get sucked into the story. But I wouldn't necessarily avoid that. I think it's important. First of all, for one thing, it's important to invest. When you're an angel investor, it's important to do things that you care about, and it's important to invest with people that you like. I mean, after all, it's your money, and I think uh, being investing and supporting people that you believe in and you like that have charisma is great. Personally, for me, the things that indicate for me that help me assess uh, sort of founder market fit are the a lot of intangibles around the person and the command of the issues. Even if it's somebody that, whether regardless of whether it's somebody with a lot of experience, not a whole lot of experience, the entrepreneur, the person telling the story, needs to have a command, a strong command of the important issues that are being discussed. They need to understand the market. They need to understand the problem, the solution. I think this is where experience can come in and be useful. Sometimes you're going to look at credentials, what jobs they have done, what degrees they have. That might be important. I mean, if it's a research with a new innovation, what lab or what university or what where they came from can be important. I think you also want to look at the entirety of the team and the experience or the elements that they provide. And then, of course, finally, I would say credibility can also be demonstrated, market fit or founder market fit can be demonstrated with the traction. Nothing speaks better than the numbers, of course, when it comes to the results.
And before I move into discussing about experience, I want to go back to the traits that you see in founders. And I wanted to ask you, what is this trait or distinguished quality that is overrated and often confuses investors that you see in the founders that have pitched to you?
Well, that's a difficult question because I don't, I mean, I can only speak from my own experiences. So I can tell you what
But
confuses
it's
me.
25 years of
Yeah,
experience that you
yeah.
have, Credo.
Well, I will tell you what I keep coming to is quality over quantity. Uh, I look more and more. The older I get, the more experience I have, the less I look at the numbers, and the more I look at the qualities of the people. And it's hard to believe, but every time that I make a mistake is usually because I misjudge a person or a situation. But it's not about the numbers, it's usually about the qualities. Um, a lot of these intangibles and the values that people have.
Okay, perfect. And going back to this experience quality, how do you weigh deep domain experience against fresh outsider perspective when you're judging a founder market fit?
Yeah, that's a tricky one, I think, because I think the obvious answer, the obvious expectation, is that somebody experiences is going to be somebody better. But I will tell you, I keep making the mistake of investing in experienced people because of their experience, and being completely disappointed and seeing them fail because of it. I think it's very situation dependent. I think a lot of it has to do with what industry you're investing in, what stage the industry is in. Is this an industry that needs disruption, or is this an industry that needs evolution? Are you talking about creating a new market or disrupting an existing market? I mean, this is where an experienced person in an industry can be counterproductive, right? You can continue to have somebody who is going to try to continue with the process as it already exists, replicating perhaps some of the mistakes, and sometimes this complete disruptions or creation of new markets are much better done by somebody who is completely from the outside and has a brand new perspective. But again, I think it's very difficult to generalize. But I would probably, if there was something that you want to, roughly speaking, align, it has to do with what kind of situation you're dealing with, whether it's an evolutionary situation or a disruptive situation.
Perfect. And yeah, we've had examples just 20, 25 years ago when the social communications needs changed. It was the non-experienced like Mark Zuckerberg creating Meta
Yeah.
and different people creating Snap, different that disrupted the market, right? And I think it's really valuable what you're mentioning. But going back to this experience and how it plays out really important role, I want to go more through the team composition topic. And it's because mixed founder experience boosts survival odds. Sometimes you need someone that is more like the CEO role, but also right now it's very common to see the CTO, the tech role that will create the software depending on the startup, but mostly startups are right now into tech, right? So how do you think complementary founder backgrounds change your confidence in founder, and how do you check that? And it's
Uh,
very important in pre-seed and seed level, right?
yeah, I mean, I do think that complementary founding teams help, but I don't think that that necessarily uh, changes. That's independent, I think, of the founder market fit. So having a technical founder working together with a sales founder is going to be an improvement over having just one of those two types. But you still need to have the founder market fit. You still need to have a deep knowledge, a deep domain expertise. You have to understand the problem, and so don't confuse. I think, don't confuse the complementary nature of those two different pieces with founder market fit. It's a completely separate thing, and it has to be evaluated separately.
Yes, and I think that's where some people make the mistakes because they see that someone is really good at the sales pitch, someone is a really promising tech star, right? And that's where they don't see and they miss how they're attacking the market, right? So I think what you're just mentioning is it's very valuable. Now I wanted to touch base into, now that we're talking about the founders, into serial founders, because there's data behind that prior success increases the probability of future success, right? And we've seen that in venture it is very common that a past founder that has already exited or raised money is most likely to raise money. How much credit do you give repeat founders on founder market fit, and what proof do you still require that their playbook maps to this market?
Yeah, I think same as we said before. Uh, Repeat founders are not necessarily good, don't have necessarily good founder market fit. It depends on the situation. Um, and just like what we discussed before, if you have a fresh perspective, you can be more intuitive, more insightful, and come up with better answers. I think, in fact, there is probably a warning sign that should be associated with a second time founder, in particular, second time founder. And I was told when I was early in my career never to invest in a second time founder. Third time founder is okay. First one, of course, yes. But second time founder can be the most dangerous because that person sometimes, and of course, we cannot generalize, but the second time founder can be somebody who thinks that everything that they touch, everything that they do is great because they've done maybe really one startup. Uh, Oftentimes, if you've done it only one time, you're doing it for the first time, you're a little more afraid and you're more cautious. If you've done it three or four times, you've learned some lessons. You probably haven't been successful every single time. But the founder that has never experienced failure is the most dangerous one because they feel that everything that they do is great, and they lack sometimes the discipline to do the work that it takes to understand the market well, to do the research, and rely too much on their prior experience. So I think it is important to have a team that knows how to work together, how to operationalize things to reduce the operational risk. But that only, again, eliminates some of the risks. The founder market fit doesn't get eliminated by being a repeat founder.
Perfect. And no, I think it's very valuable that we discuss first these topics before getting into the specifics in market fit founder, because I believe, these are common issues and common mistakes people doing due diligence tend to
Mm-hmm.
commit, right? And
Yeah,
it's
yeah.
they get biased by, no, is this person has already raised capital? They get biased, no, it's a really good complementary to them, or different stuff. So now getting more into topic, they go to market fit. And this go to market fit is part of the founder market fit, which is really important. So I wanted to ask you, what early go-to-market strategy proof points best demonstrate founder market fit with the buyer and not just the end user?
Yeah, I mean, obviously, the best way to demonstrate uh, founder market fit is revenue, is traction. Now, I think depending on the sales motion, you're going to have different levels of indication of success and market fit. What I tend to look for, and this is what you need to do, obviously, when you're doing seed stage or pre-seed investing, when sometimes revenue is not there or is very early, is I think just like with any private equity deal, with any company, you want to look at the history of success. Well, the trick when you have very little history is, well, how do you do that, right? How do you go back in time? How do you project the growth of a company? And the cheat that you can do is to looking at leading indicators. So if you can establish the appropriate leading indicators for the company that you're dealing with, then you're going to find that you can see the trajectory. You can anticipate when the revenue is going to come. Revenue is the ultimate predictor of success for a business and profitability, of course. And then getting customers is important. But if you can, for example, you get a number of visits, and that number of visits is going to indicate that there's going to be a certain number of demos. And those number of demos are going to indicate a number of sales. Well, if you can establish that pattern there, if you can understand that for this business, these are the leading indicators that lead to success, then you can start to go backwards and start to use and predict the trajectory of the business and the market fit. I think even with these indicators, though, I think it's important to remain skeptical. And I think perhaps the one thing that we haven't mentioned much about is, as an angel investor, the thing that is most useful is to continue that skepticism and to realize the stage that you're investing in and to stage your investments. Uh, if you are making one investment into a company, well, that you have one shot. I would prefer, I think, as an angel investor, when I made angel investments and when I make investments in venture, is to increase the size of my investment in one particular company as I learn more information, and to stage the investment, if I can, as well as the due diligence, by looking at how many visits, demos, sales, or whatever other leading indicator I might be able to find that are go-to-market proof points for that business.
Perfect. And let's discuss about example and enterprise realities, right? So, for example, the because enterprise, let's say SaaS cycles are longer and riskier, and the process rigor matters, and the quality of your design partners is critical. The right titles, a real budget owner, and an authentic procurement path, not just friendly technical champions that it's different than when we discuss about other startups. So, for example, in enterprise B2B, what constitutes a strong founder market fit at a pre-revenue level, who the design partners are, what they do, and how quickly the founder can iterate and meet those requirements.
So you're saying that a SaaS business, enterprise SaaS business, really early, and what sign of product market fit? Well,
Exactly. Yes.
that's a tough one. That's a tough one. It goes back again to the point that you're making. And the reason why I say this is because um, sometimes good entrepreneurs are good at telling you the story. But you know what? Especially when it comes to charisma, great entrepreneurs are good at getting customers to the to the finish line. But but the budgets are what really determine, and the actual transactions is what determines whether the business really needs or wants this product. So I cannot tell you how many times I have had conversations with large companies, big B2B enterprise companies, that are telling me, yes, they're going to buy this product. I am talking to them in due diligence and checking with them, and they're telling me, yes, they're very much interested, they will buy the product. And 25 years later, I'm still waiting for those companies to buy those products. Uh, so part of it is because they get hooked by the charisma of the founders, just like we do. And there isn't anything that is perfect early on for pre-revenue companies that are going to give you a foolproof guarantee. So that doesn't exist. So you shouldn't expect it. Um, that's why I go back to the qualitative aspects of entrepreneurs. There's a bunch of other aspects that can help you. And then pacing your investment and waiting for the revenue to come in. And continuing to look at leading indicators, but waiting for revenue to come in to be convinced that product market fit exists. Sometimes, honestly, it's not a matter of yes or no for any risk or for a fit, like product founder market fit. It's a matter of degrees. It's a matter of uh, how comfortable are you pulling the trigger on an investment or not.
Perfect. And now getting into the topic of macro shocks, macroeconomic shocks that may happen and that may affect these early stage companies, is, even quality companies, big companies are stress tested by these cycles, right, in the economy. Resilience and learning, velocity matter to survival. So, which resilient markers tells you a founder fit and with the market and through the budget when the budget freezes or the platform shifts, or there's macroeconomic changes that may affect these startups.
Yeah, I think that is where experience does matter. So when it comes time to macroeconomic conditions affecting markets, uh, the more experienced entrepreneurs tend to do better. And this is just simply not just about product market fit, but changing conditions. It's about operational risk. So what happens when a market gets disrupted, when there are some macroeconomic conditions affecting every single business, it's more about firefighting and emergency situations. The teams that are going to do better in that situation are those teams who have worked before together, who know uh, who know the hierarchy that is in place, who knows each other, who have done it before, who have experience. So to me, I would consider that a little bit different than founder market fit. I would consider that operational experience, and that's a situation where a new young, maybe younger, less experienced founder could be difficult, could have a difficult time. So I think that's another level of an element of risk. Um, but but it doesn't mean that a young entrepreneur or a first-time entrepreneur can never overcome those issues. I mentioned qualitative factors before, right? And to me, those tend to be more important. So even if it's a first-time founder, even if it's a young founder, what I look for are things like resilience and drive and and exceptionalism in what they do. And these are things that can be observed in founders independent of their prior experience. You can see them in real life and in other moments of their life. So these are qualities that are going to shine and come through when market conditions are bad as well as good. And it's usually, for me, what ends up determining the bigger factors for success.
Perfect. And now that you touched that topic, I want to switch a little bit to the founder perspective. And it's, what's that thing that you as an investor look let's say in their deck, in the 30 pages or seed deck, yeah, that makes and proves that they have like a founder market fit. Like what's that hard artifact that they should have?
Yeah, I think what I look for is knowledge and is understanding of the problem, a deep domain expertise. It doesn't mean that they need to have many years of experience working in the field, but they do need to have a good command for the problem, and they need to have a good understanding of what customers are experiencing, and they need to understand what competitors are doing. Um, and then, of course, I want to be able to evaluate some of these qualitative factors that I discover. There's another element that I usually want to see in the companies that I am investing in. And this is a personal preference, but I also think it's a key component of high growth businesses, and that is innovation. Um, and an innovation at a magnitude level, right? I think um, I think it's pretty much obvious. It sounds obvious, but I'm always surprised by how many companies come to me and are describing that they're fixing a problem, but they don't really talk about or they don't really show to me that they're truly innovating. And I think innovation is very important because without innovation, it's very difficult to create separation from competition. It's not just enough to fix a problem. Part of that is because pretty much problems become apparent throughout the world, throughout our market, to multiple people at the same time. And the companies that are going to succeed, usually, are going to be those companies that are doing things a little bit better, a little bit differently. And the innovation doesn't have to be technical only. It might be on the go-to-market strategy. It might be on the sales process. It might be in some other aspect. But it's important that they understand that the innovation is what's going to drive that high growth.
And now that you say that, there's uh, accelerating your product market fit and the founder market fit odds requires focused iteration, customer proximity, and disciplined go-to-market hypothesis, right? So for those founders that are watching us, can you please give me a 6-month plan for a founder so that they materialize their founder market fit before fundraising?
Yeah, 6 months is not a whole lot necessarily, but I would think it depends on the stage, um, and depending on where your company is. Of course, there's a lot that can be done in 6 months. But what I would do if I'm a founder and I have 6 months to try to put my best foot forward with investors. I would self evaluate what are my biggest risk factors, and I would try to reduce those factors, those risks. Um, I would think, for example, I would try to better understand my customers. I mean, we just talked about how important it is to have domain expertise to understand the issues. And number one, if you don't know your customers well enough, well, you better study your customers uh, during those entire 6 months. Along the way, as you study your customers, you're going to have to learn about your competition, of course. And then in 6 months, probably a lot you can do. You can do things like strengthen your team to give you more credibility. Perhaps if you're not experienced enough, you can hire somebody that has domain expertise or that has industry experience. Remember that when we're talking about founder market fit, we're not just saying the one person in the team. Maybe it's just a team of founders as a whole. And when you just add one person to the team, it completely changes the dynamic and the way that team is going to be viewed. So maybe adding another person to the team that has the qualities that you're missing. Um, but even things like achieving technical milestones or achieving some sales milestones are always useful to do if you have a 6 month time frame. Again, I think the most important thing is reduce the biggest risk in front of you. And that is what's going to lead you towards what needs to be done.
Thank you, Lister. I like to ask that question in the founder's perspective, that what they need to do, because for an investor, it
Mm-hmm.
gives you what you need to ask based on that response. So it is a good one. And to finish, and then we will open it up to Q&A and answer the questions that are in the chat. And my last question, it's what's your go-to strategy to ask these founders and to test this product, the founder market fit that
There,
you
I don't.
haven't mentioned, like
Yeah,
a tricky part that you haven't mentioned. Yeah.
I mean, I guess what I would say is it's important for investors to understand staging the diligence. Um, so, I mean, when I'm looking at a company, I would try to have multiple conversations. That's number one. Remember that when you have a company with a lot of history, you can evaluate the company at different moments in their history by looking at financials. When you don't have a company with a lot of history, what you can do is still look at multiple points in time and try to see how the company is moving. Because I think due diligence and evaluating of companies is not looking at one point in time, it's looking at a path. And you need multiple points of evaluation. So I would stage that diligence if you can. I would try to understand and get to know a founder over a period of time. And of course, sometimes as angels, we don't have much time to evaluate a company, but even if it's over a period of different days or weeks, try to separate and have multiple conversations. And then I also focus on quality, the quality rather than quantity. By that I mean, look at the founder for their exceptionalism, how exceptional they are as individuals, how resilient they are, um, and how they surround themselves with people. What kind of quality people are surrounding them? At the end of the day, reader, no matter what business you're dealing with, no matter what situation, you like the industry, you like the business, what is really going to be the biggest driver of success on your investment is going to be that. Is this an exceptional founder? Is this an incredibly driven founder? Are they resilient? Are they ambitious? Those qualities are the ones that are going to most likely determine the success more than pretty much anything else, any number, any go to market strategy, revenue today, market conditions, anything else like that.
Perfect. No, that those are great insights, Lister. Thank you. And and we have some questions in the chat, and we're opening it up this time for Q&A. So if you have questions, just put it in the chat. We have Tiago, and Tiago asked us, well, thank you for coming. Have you ever invested in South America markets, whether in Peru or elsewhere,
No, I have invested
Lister?
in South American entrepreneurs, but the fund that I manage explore investments in Latin America, but it was driven by certain individuals. See, this is one challenge with being a venture investing and having to invest other people's money for the most part. I have to be driven by the investors writing me the checks. So if it were up to me, I would have expanded a little bit more. But I haven't invested in a company in South America. But I have invested in founders from South America working in the U.S. market.
Perfect. And Manuel asks us, what are the key factors to get funding at pre-seed with no traction yet?
Uh, I think some of the things that we said, telling a good story, understanding your market well, um, innovating. I think we tend to get pulled towards the flashy, shiny object. Right now is AI, but there's a whole world of opportunities, uh, beyond that. Sometimes the best path to take is the one that not everybody is taking, and it's also much less competitive. And sometimes it's funny how when people do that, the world comes around and follows you, ends up in your way. I think also as a founder, the most important thing to do is to not look at venture money as a goal, to view it as an instrument, as a tool. And I think if you do that, it doesn't matter what business you're creating. You use the funding that you need in order to serve the purpose of the business. And if you're passionate about your business, whether it's a high growth business or a lifestyle business, uh, then I think you find the right tool, the right instrument. You're more likely to be successful that way and to be greatly successful than to simply try to say, how do I how do I raise the most money? At the end of the day, that's not what's important. Raising the most money is not what's important. Getting the biggest investor is not what's important. Being a successful founder, a successful entrepreneur, and whatever you want to do, that's what the goal should be.
Perfect. And now, next question from Eduardo is, how have you engaged and how well a team works together? And do you ever ask startup teams about failure when evaluating a company?
Yeah, of course. Especially for successful founders. My biggest problems, my biggest question for successful founders is to my biggest point of diligence when I'm evaluating a successful founders is those points of failure. I think a lot of founders try to talk about all their successes, but really, we don't really learn a whole lot from success. Most of the lessons that we learn are from the failures. And sometimes obviously those successes and failures may come from the startup, but even before, or even in other aspects of life. But this is to the point that we were making earlier. It is very risky to invest in a founder who feels that they've never failed, because there's nothing more dangerous than that. They feel that they can do anything. Um, at the same time, you don't want a founder who feels that everything that they've done has been a failure, because you need somebody who has got to believe in themselves and believe that they're capable of working successfully in the new business.
Perfect. And we have Christian who asked, can you share some questions or topics that you ask founders to drill down deeper into subjects, into subjective topics like resilience, perseverance, and decision-making acumen?
Yeah, I like to engage in conversations with founders to try to get to know them, and because I think that is much more uh, it's much more important than try to simply listen to their elevator pitch. Sometimes when you get somebody out of their elevator pitch mode, you end up getting the real person behind, right? That practice pitch. Uh, so that's why it's useful, of course. To This is part of the reason why sometimes it's important to have more than one conversation. You need to let the founder talk. You need to let them pitch. But then outside of a pitch deck, you ask questions like I mentioned before. you know, why did you start this? What is your origin story? Tell me about the beginnings. And sometimes it's not so much the question that you ask, but how you follow the threads. I think this is the other piece that maybe more experienced investors are able to do. When you ask a question, don't just leave it there. Don't just go to the next question, but dig in. I think it's important to try to go in deep, because by nature, a founder is going to try to provide a shallow presentation of themselves, and usually is going to try to expand on the places that present them the best, and they're more comfortable with. And obviously, they're going to try to hide or ignore the areas where they are weakest or more insecure. So if you listen, you might be able to understand what those are, what areas they want to move away from. And I think this is not a matter of trying to catch them. It's a matter of just trying to understand the risk, right? It's not about trying to demonstrate that you know better or that you got them. No, it's a matter of trying to understand, look, I'm going to give you money. What is your level of risk? And be honest in that conversation. Try to understand where those elements of risk are. And that can only be obtained with somebody who's really good at pitching, especially when you follow the threads and you go deeper and deeper, and then just ask a question, but ask follow-up questions to take you to the elements that are important.
Perfect. And we have Christian who asked, can you share some? Oh, no, that's the same one I already read. Jamie asked, how often do you see founders building products without a personal connection to the product or service? And how important is it? Going back to what you mentioned at the beginning, that is, you have to have a good story behind how it's part of the sales pitch, but sometimes
Yeah. If,
is there
it,
a personal connection, and is how powerful is that?
I mean, I see all kinds of founders. I see founders of all types because that's what I do all day long. Um, but I'll tell you, I don't talk to the founders that don't have a personal connection to their products very long, and it comes across. Uh, but I think personal connection to a product can come in many different ways. It could be somebody who has lived the problem, somebody who has used the type of product, who understands it. But it could be also somebody who's got a passion and have a strong interest. So I wouldn't necessarily generalize and say it has to be somebody with many years of experience. I have invested in 18-year-olds that could tell me, this is, for example, one of my more successful companies. I invested in a kid who was 18-year-old many years ago. This is when email marketing was getting started. He could tell me everything that that business was doing. He could tell me everything that his competitors were doing. He had a strong passion, even though he really hadn't. He was still in college and didn't, or barely in college, and but he has so much passion for that business that it was clear, it was understandable. I invested in a couple of kids who quit college to sell a product. I don't know that they were necessarily passionate at the beginning, but they developed a very good understanding. They built a unicorn company over the years. So I think what I'm trying to say here is that that personal connection and passion shouldn't be judged by how old a person is or how many years they have working in that industry. It can come in different ways.
And you before you ask, and I'm going to read this question from Angel, but as context, you mentioned briefly before that sometimes when you take a look into the founder market fit, it depends into if the industry they're involved needs to evolve or not, right? So Angel is asking, as markets evolve rapidly, especially with AI and automation reshaping categories, industries, how do you reassess founder market fit over time? Can it erode or even improve as the space changes?
I mean, that's a lot. There's a lot right there because I think we're going through. The one thing I will say is, in general, the pace of change continues to increase. The acceleration of the acceleration of change continues to increase. When I was when I first started investing 25 years ago, I could invest in a company with a good idea and a good product, and I could probably write a check. I felt confident that maybe there were other companies out there, other entrepreneurs starting new companies. But I knew that I could wait. If I look carefully, I could wait a few years, maybe 5 years, and there would be some competitors, but there wasn't anybody established. Probably there weren't going to be anybody new that would come in and take over. And then it went maybe perhaps from 5 years, 25 years ago, to four, to three, to two. Now I have made investments in companies that I felt were completely unique, and 6 months later, there's 40 competitors. And in the time of AI, when the product itself, especially if it's a software product, uh, doesn't offer differentiation because AI can build the product with uh, very little technical power from individuals. It's almost impossible to bet on that. Um, and I think it's more important than ever to focus on those qualitative factors. It's about, you're trusting an individual or a team to try to do whatever they can to pivot, to change, to adjust. And resilience and innovation and exceptionalism and drive are more important than ever because the product itself, it's no longer really what it used to be, the differentiation that it used to be. So I think we are entering a period of time of a lot of change, and we don't really know what the world looks like. But the one thing that I do know is that entrepreneurship is not going to end, is going to continue. And there's always going to be people who are creating and innovating. and there's always new things. I think we feel every time that we come to a point like this when there's significant transformation that the world has changed and no, it's never going to be the same. And I think this one is a pretty strong one right now, but I just have this feeling that this is just another cycle, and we're going to see continued progress and continued acceleration and innovation, and uh, but those fundamental elements, found their market fit and qualities that we need to see, they're not going to go away. They're just as important.
Perfect. And last couple of questions. They were asking to share an investment that you made and went well. I think you already covered that with the example you did with the 17-year-old. But they're also asking of one startup that had excited you a lot and didn't turn out well. So what happened there?
Well, I mean, yes. Speaking to second, I invested in a company. This is another company that was called. It's a company called Pendo. I invested in a company, and maybe I should not. Maybe I'll give another example because I don't want. I shouldn't be naming companies. I'll give you another example of another company that I invested in. It was a big success, very quick. It wasn't a unicorn, but it was a very healthy return. Uh, and that was the first company that he invested. I invested right away in that founder without blinking, without even thinking about it, because I was so happy with my investment, and I just felt almost the obligation to invest in that founder. That was one of the shortest investments I ever made because maybe about a year and a half later, the company went under. And I think the example there is one of the lessons of a few times I've made a mistake of investing in a founder that maybe had been successful, and I just didn't look at the end. I just skipped the rest of the process because I just felt that, hey, this guy was successful, I can just trust him. But there were a lot of elements that if I had just paid attention, it would have been obvious. The product market fit wasn't there. The market had other competitors. It was very quick, and it happened very quickly because there were so many signals that the business wasn't going to work. And I made the mistake of just simply funding the money. And honestly, at the end of the day, what I go back and think about is I don't think I helped that founder by giving them money because he ended up wasting a year and a half of his life, really pursuing a business that he should not have been pursuing.
Perfect. No, that's a great example. And and the last question, it's Oscar that is turning the question around, and is what should I as a founder, what should I as a founder looking for the right VC? What should I ask them to bring me other than money?
I think it depends on, like, I mean, half of my answers are usually it depends, but I think in this case, very much so. It depends on the stage. Uh, it depends on the industry. Uh, but for the most part, you want a team, you want to look at your investors as part of your team. And if all they are providing is money, then it's very, very dangerous. So when I say it depends, I mean, is this a local investor? Because I think there's a set of resources that a local investor to your community can provide to where you are, where your business is. Is this an investor who's going to bring you credibility? Is this a brand investor? Uh, do they have experience with boards and helping grow companies? I think what you want to do is look at your whole set of investors, the whole syndicate, and try to create, just like advisors and mentors, a diversity of perspectives and views. And you do want to have a mix of people. You don't want everybody to be aligned and to be the same. I think at the end of the day, also, what you want is investors who trust you to build the business, who are not going to get in your way. Uh, they're going to tell you when you're not doing something right, but they need to trust you to build the business and will be there for you when you need them, for whatever it is that you need them for. whatever aspect that you feel that that investor is really good for. Um, and so obviously there's going to be some investors that you need when you're first getting started, and then the nature of those investors changes as the company matures and progresses. But at the end of the day, you want a partner, you want a teammate, you want somebody who can help you build a business and not just be somebody who's there to make money from you. Most investors, I would say, most professionals investors, and angel
Perfect.
investors tend to do that.
Yeah. Okay, Lister, that were all the questions in the chat.
Great.
Thank you for
Jeshua,
your
thank
time and for
you.
your great insights.
No, great job. Great job with
And
the
yeah, the
questions.
invitation is for everyone. The invitation is for everyone in the chat to join Angels Investors if you're interested in investing in the most promising startups in America. Lister is part of this angel group. And one thing I want to mention is that we do due diligence together. We analyze the startups together, we jump in a call, and that's something that no other angel group does. And if you're interested in investing in this early stage, you can do it through Angeles. And our invitation is for you to become a member if you're not. And well, Lister has been a member for over 2 years, and you can see the network how it is, how good it is. So Lister, thank you for your time, appreciate it, and thank you for your insights, and thank you for this great conversation.
Thank you.